So the previous one is the income statement, and this one will be balance sheet. And actually, we kind of cover balance sheet a little bit because they always connect together. When you do the double entry, you affect in your income statement, sometimes you affect on your balance sheet. Okay, so there are 5 learning objectives on the topic 4. So we mentioned about the first part, we just review the elements and format for the balance sheet. The second one is to try to differentiate the current and the non-current in the asset and the balance sheet. So we know with the on the asset, on the left-hand side of the asset, on the right-hand side liability, they have a similar structure we present in the current and versus the non-current using 1 year as a cut-off point. So most of the time it's 1 year. And then in objective 3, we also look into the last component in the balance sheet, which is the shareholder equity or owner's equity or stockholders equity or net worth. There are many different words. It's talking about the section, equity section. The learning objective 4, common size. So just like what we learned common size in income statement, we also have the common size balance sheet. So what you need to pay attention is that which variable will be the denominator when they are trying to calculate the common size. Okay, so you remember when we try to get the common size in income statement, everything will divide by sales. Okay, so it's a percentage of the sales method. And so here we gotta show you there's no sale here. So which variable we gotta use when we try to get the common size to compare the company A with the company B. Learning objective 5 is there are 2 important sections of the financial ratio related to this balance sheet. One is liquidity, the other one is solvency. And so I know some students are asking about this one in the beginning of the semester because of your project. Part of it, we want you to do the liquidity and solvency analysis. So this will give you, actually it's not that difficult. You just need to know the formula. And where can you get a number and put into the formula, and it's very simple to do the calculation. But most important is how do you interpret the result. Okay, so that is the most important. So today we have probably 30 minutes, 35. So we'll try to see if we can go up to the learning objective 2. And we'll continue the rest of Thursday. So there are different names for balance sheet. So sometimes I just put BS, don't like the word, but it's easy. People put income statement, IS, or profit and loss, but this one is a balance sheet, which is the first letter of the 2 words. Okay. And it's showing you the company financial position. So you know the balance sheet normally when they present it, they always say as of what day. And so the company start the balance sheet from the day 1. So most of the account accumulate over time. Okay, so you always see some account when they try to calculate, they have a beginning balance carry forward from the year before, the previous period. So the end of the balance, the end of a year of account will become the next year of the beginning balance. And you make you try to account for any kind of change during that period of time and come out end of a period of the balance. And most of the time you see the balance sheet you can look into monthly or quarterly, but most likely people are looking at it annually. Right? So you will see the balance sheet as of end of a year, and sometimes it's based on the company fiscal year. You know, fiscal year is different from the calendar year. Well, I show you April. Fiscal year is the last week of September. So their balance sheet will cut off as September 26th of 2011. So it's not end of a year. So this is a difference that you need to know. So the balance sheet separate into the 2 parts, right? So on the left-hand side is the asset. On the right-hand side is the liability and the equity. So the asset is showing you what kind of asset they control, they own. Okay? So this is how they use the money to purchase, to own that. On the right-hand side, liability is showing how much money company own to some creditor. And the equity part is if a company go liquidity, go bankruptcy, how much money will left for the shareholder or owners to claim for. Okay. So this is a equation. I hope you get tired of this one. You remember that by heart already because we showed it many times. Asset will be equal to liability plus equity. And you can also, most of the time you want to find out the equity is subtract liability from the asset you can get. So that makes sense. The owner's equity, which is the owner, they can claim how much money they can share if a company go bankruptcy. You need to look into all the value. You try to liquidate all the value of the asset. Then you pay off the liability. And whatever left, this is what owners can claim for. Okay, so this one formula can become two formula. So this one you need to measure when you do the double entry. You always have to balance. And this one is the most people care about is net worth. Net worth of the company is this one. So you think about yourself as individual. This concept can apply to your personal finance. So when you go into bank and you want to borrow the money to get a mortgage loan, or you want to borrow money for your dad's business, they will asking you for the financial, right? And if you, for you yourself individual, you want to get a loan, they want to know how much net worth you have. So you will think about what's my asset. What is your asset right now, students? Well, assuming you don't have a job, okay? What's your asset right now? Did you have a bank account, right? What else? Do you own any bicycle or motorcycle or car? That is your asset, right? They can use it for a long time. And do you have any other saving gift from your parent, grandparent, family? Yeah, that would be good, right? So this is all your asset. Is any other asset I forgot? No. How about your liability? So if I want to know your net worth, is I trying to take your what's the asset you might have, cash, car, house, whatever, and we want to also take your what's the liability you have. So what kind of liability you might have? Huh? Student loan, yeah. Credit card debt. What else? If you borrow some money from your roommate, that's your debt as well, right? So you gotta need to go down the list to see what's your liability. And so you're using the asset value subtract the liability value, that will be your net worth. So when we are trying to calculate the company net worth, it's follow the same situation, same concept. So here's again to tell you each item. So as you can see, the asset and the liability, the way they present is similar, very similar. We look into these two, different from the equity. So the asset always present in this way, current asset and non-current asset. Liability including the current liability and non-current. And so in finance, normally with financial accounting, normally current and non-current, we're using 1 year to tie up. Sometimes they go by the company business cycle. They're also workable. But this is based on the GAAP, because most of the time, most of the United States company, they go by the GAAP. So they present the current first, then the non-current. But if you go by the IFRS, it's reversed. But in this way, we feel it's more makes sense because it's go by the degree of liquidity. Okay, here comes the liquidity. So liquidity means is how the easiness or degree of a company can convert this item to cash. Okay, so liquidity is good, right? Higher liquidity, that means you have a lot of asset you can convert to the cash quickly. So that's why it's very important to evaluate company financial health and look into the liquidity perspective. So you can see the presentation of a current asset is normally go by the liquidity, degree of liquidity. So cash is cash. Cash doesn't need to convert to the cash, right? What's the next? If a company has some saving account, CD, they can be expired in 1 month, 3 months. They can easily convert, right? What's the next? Account receivable. So the company give the customer credit. They probably pay credit card. Credit card can probably collect in 3 days, can be 10 days if you give them the term, maybe 10 days, maybe one month. You got collect as well, right? So this is in the current asset. The other one is inventory. We mentioned about the 3 types of inventory. So if the inventory is a complete set up product is ready to sell, you can easily to sell that and you can convert it to the cash. The other one is a raw material. If you don't use that, you can sell back, you can return, you know. And the most difficult one is work in process. So this is how we present the current assets based on the degree of the liquidity. Does it make sense? How about current liability? Similar. Based on the degree of liquidity, how fast you need to pay for that. So they will come out account payable. Account payable. So account payable is you buy the raw material on your vendors, and the vendor give you the credit. You need to pay back the money. So you're a construction company, you buy the lumber from Home Depot. Home Depot give you a 2 weeks credit. So in very short period of time, you're gonna need to have the money available to pay. Does it make sense? The other one is the wage payable. So the company don't pay employee salary every day or wage every day. It's too much trouble, right? So most of the time they pay weekly or they pay semi-monthly, so 2 times every 2 weeks, or they pay in the middle of a month at the end of a month, 2 times, or pay them monthly. Okay. So today is the 8th, right? So which is my example always tell you my last payday is the end of the month. So I work for 8 days. So then you pay 2 times a month, so it will be 15 and at the end of the month. So I already did 8 days of job, but I haven't got paid yet. So they owe me wage payable, salary payable 8 days. So this will be their liability, and it will come true very quickly. So they need to have the cash available to pay. So this is a very short-term liability. Tax payable. If they withhold the income tax from the employee's paycheck, based on your marital status, based on the salary you earn, the IRS is the tax book to show how much money they need to withhold from your paycheck, right? And so they withhold the paycheck, the money, the tax, and they accumulate together. They don't pay to IRS right away. So they will become tax payable. So normally, if I remember correctly, we do the tax return to IRS as from a company perspective at least once a month and a quarter. And so if you collect from 15 and 30, the income tax withholding, you will not pay to IRS right away. So you accumulate together and you probably report it in the 15th of the next month, all the quarters, then you pay all together. So they'll become tax payable. The other account also can be in current liability. It's a long-term liability, but there are some portion have to be due, have to pay within this year. So you cut it off and point to here. Okay? Then we look into current versus a non-current. Okay, so there's a current versus a non-current. So the non-current, which just means this part of the asset of liability, you can enjoy that this asset. You can enjoy more than 1 year. Okay, so you remember we're talking about the fixed asset. Company buy the computer, you will not expect to expense it out right away in 1 year. You can use it for 3 years or 5 years until you update it. Company is a machine, they might can use it for 10 years. Okay, so there's a PPE, normally we'll go into here. So in this non-current part, there's a one fixed asset, long-term fixed asset, you can use it for long life, long years, many years. There's another one's intangible asset. Intangible asset versus a tangible asset. So tangible means you can touch, you can see. Intangible is no physical subject for you to touch. So what's an intangible asset? Patent, right? License, intellectual property, trademark, goodwill. You have an exercise question goodwill, which is we're gonna show you. I remember it's you asking Rachel what is a goodwill when you're trying to do the diagnosis exam. We got exercise and we gotta show you what is a goodwill. So those are intellectual property. When you say intellectual property, right? Yeah, and there's a intangible, so you cannot see that. So they were tangible, intangible, or under this part. So they are not current. And so in fixed asset, we are involved with some depreciation, accumulated depreciation, what we are trying to do in the last topic, right? And this time we got also look into what is the intangible asset will be. So this is the asset. And here for the liability, anything like liability, you don't need to pay within a year. So company can have a line of credit, and you draw the money and you pay, and according to the contract. Now credit sometimes can be here, but then most of the time there is auto renew, so company can continue to use. But most of the situation is a bond. Bond is a major way for the public trade company. They try to raise the capital to support their operation. So you can issue the bond. What we showed you earlier, you can issue the bond, which is a callable or pullable or convertible or just a single straight bond. So there are many different kind of bonds company can issue. And most of the time you go to the investment bank and they will help you. So it depends on company credit history. So they can issue premium bond, discount bond. So we have a specific session. I forgot which topic, maybe topic 8 or 9. We're talking about the bond. So we'll talk about the bond accounting as well. Any other long term? Yeah, you can borrow some money for 3 years or 5 years. And you just follow the contract to pay that back. And so company can get some construction loan to build a manufacturer. And they can have an install payment to pay every year, interest plus the principal, or they just pay interest until the last year to pay off everything. So they could be long-term liability as well. Okay, so do you have any question? I did not show you account, but you understand, you follow me, which account I've been trying to go through for each session, right? On the equity part, so we show you some example before in the equity. So company can issue the common stock, and company can also issue preferred stock. So this is the most true common stock the company can issue. And if you remember in the diagnosis exam, we also have this account. So my student doesn't know what that means, additional paying capital. So when the company raises the capital by selling the stock, just like you sell the bond, okay? This is a support the company long-term operation. So it's a very important financing tool. But you sell the stock, there's a face value. But sometimes the investor willing to pay more than the face value. So the face value part will go into this account. And anything over the face value will go into additional paying capital. So this is say if you face value is $10, but investor willing to pay $20. So there's a $10 additional. So $10 going to here per share, and the additional part will go into this account. There's also sometimes you can see another account. It's treasury stock. So we just mentioned about treasury stock. Treasury stock is a keyable of whenever company buy back the share from the market. So why the company need to buy back the share? Too much money to spend. You buy back the share, how does that work? Company can go by themselves, or they can hire third party to help them to buy back the whole chunk of the share, or they can just go to their major institution investor to tell them you want to sell back and buy back They can go to specific person when they own a lot of share. It will be easier instead of going to the open market to buy back the share. So, like for example, company right now has 1 million share. Stock price is only $10. So they might think the price is too low. So they want to go to the market to buy back the share. So which is what reduce the share outstanding in the market. So just to say they buy back half of that. Okay, so let's do the math. So if you have a 1 million share right now, then you want to buy back. And so just say you buy back half of that, so only 500,000 share in the market. So original company earning per share, this is a company, this is share outstanding. This is the net income is 2 million. So how can we take your earning per share? Earning per share is the net income divided by number of share outstanding, right? Which is the basic one. So earning 2 million. Share outstanding in this situation is 1 million. So about $2. But when you buy that, your earning per share, earning no change, right? Still 2 million. And how many share outstanding? How many share outstanding now? Yeah, you only have a 500,000 share outstanding. So what will be your earning per share? Which is the increase. So there's a big effect on the earning per share and dividend per share because the denominator decrease. So which means company reduce the supply of the common share in the market. So the supply when they reduce, normally the demand will dry up actually. So if you decrease this one, they already have an impact on the earning per share, dividend per share. Company look more profitable. So also attract more investor to invest on the company. So the company stock price will going up. So most of the time when the manager decide to do the share buyback, one of the reasons they will believe the company's stock price was too low. So using the earning buyback, they can boost the earning and they can drive the stock price going up because their performance is much stronger before the buyback. So most likely, company buyback has a few reasons. They have cash to spend. So buyback is just like dividend. You share your profit with your investor, so they can get some money back. You know, not just only put all the investment on your company, never got any money back. Okay. So 2017, we have a tax reform. So original corporate income tax is a progressive tax schedule. So after 2017, change to what's the income tax rate will be? They change to fixed rate. What's the fixed rate right now? Come on, this is a very simple question. 2017, just only 4 years, 5 years ago, right? Under the Trump administration, what's the income tax rate right now? Corporate income tax.
Right now?
Yeah. 21%. 21%. Please remember, this is a very simple common sense question. You need to know corporate income tax rate right now is 21% since 2017. So in the past, progressive tax schedule can be as high as 39%. So it's a big cut. So suddenly, most of the companies got too much cash because they don't need to pay that much tax anymore. So they have a lot of cash. So they trigger the share buyback in 2018 and 19. So even though Warren Buffett's company, Berkshire Hathaway, never do the buyback, they also got too much cash to spend, so they do the buyback. Okay. So those buyback will come into effect in the equity part. So they buy back the share, they put into the account called treasury stock. We okay? I think the most important one on the equity you need to pay attention is retained earning. So this account is the one connect with income statement we mentioned, right? So there's a beginning of a retained earning, and you're gonna need to add back whatever accumulate additional retained earning if a company don't pay out the dividend. So they keep the money with the company and they will add into the beginning of the retained earning and become end of the period retained earning. So this is we mentioned several times in before. So this is an example for the asset for this company. So you can see here, asset, then current asset, you can see there's a cash or cash equivalent, which is like short-term investment. They can easily change to cash quickly. Account receivable, inventory, or order. I don't know what the order will be. So this is all current asset. And the total asset, which is including PP&E, property, plant, and equipment. And also has a goodwill, and there's some other intangible account. Okay. And they present in 2-year comparison. This is the liability. You can see from the current liability, so there's a notes payable, loans payable within a year. Current portion of long-term debt, account payable, accrued income tax, okay, then the long-term part. Okay. This is the equity. Also 2-year comparison. So common stock, they'll tell you how much is the par value. Additional paying capital. So right now everybody understand additional paying capital is here. So you gotta record whatever money additional to the face value will be in this account and retained earning. There's some other comprehensive income we mentioned in the last topic at the end. We mentioned about company can have some kind of non-realized gain and loss on the stock holding or bond holding. They can have a hedging income or gain, a loss, or they can have an exchange rate gain and loss. So we'll be in this session. And they have the treasury stock here. There's some other accounts. So they mention about liquidity, which is what we mentioned. It's very important to look into the company liquidity ratio to see if a company has a cash flow sufficient to pay the short-term obligation. Okay? So we mentioned here the gap. Under the gap, we're using the current first. We listed current asset, current liability first, then the long term. But under the IFRS, it's the reverse. Okay? So it's different. So you can see the formula difference based on the gap and based on the IFRS. So you can see here is current and long-term asset. But here is non-current first and current asset. So it's a kind of reverse. Similar to the liability. So under the gap is current first and the long-term. But here is the reverse. Okay? What is this about? Yes.
Is there a reason they don't just make some sort of a blend between GAAP and the international rules, just to make it simpler so you're not always changing?
Yeah, that's what we are talking about in the topic 2. Okay. They agree, I think in 2006 they were trying to converge. Okay. And they have many different kind of projects they are trying to fix it, to try to convert those standards together, make it easier. But not all of them are complete. Some of them they got abandoned, some of them complete. And this part, what I see, is still different. Okay, so this is equity. So this is to tell you the concept of equity. So equity, as what we say, is using the asset minus the liability. That's the book value based on accounting book. But this equity value, book equity value, is different from the market value of equity. So market value of equity is a market capitalization. It's a market which is investor willing to pay per share of the price for your company. Okay? So a lot of times, market value equity is higher than the book value of the equity. Because, and also this market value of equity can change almost every day. Because the stock price changes almost every day, every minute, right? So never can be fixed. So I told you, Apple used to be 3 trillion, or maybe next minute is under 3 trillion because the price change over time. So if they keep going up, then more chances they will hit 3 trillion again. But keep going down, they can be down. So it's up and down every day, every month. So the market value equity can change every day, every minute. But book value equity will not change that frequently because normally you report the company balance sheet that what I told you earlier can be by month or by quarter, right? Or by the fiscal year as well. So this is trying to tell you the market value can be different from the book value. So that's why we come into investment. So the investment, you can find the book value. But when we are trying to find out, is trying to using the company financial, free cash flow, or earning to try to find out what would be the intrinsic value of a company value should be. And we compare to the market value and try to invest from there. So this is another example to consolidate company balance sheet together. This is in dollar a month, okay, for 2 years, 2010 and 2011, and the percentage as well. So this is actually common size. Okay, we haven't go over it, but this is like kind of tell you, you can see in the percentage one is all 100%. So what is the denominator for them to calculate this percentage? Since we show this slide, so we can talk about it right now. So what's the denominator? So this one's an asset, right? So this is like kind of, is it Europe country, not American country, company? Because you can see here intangible asset and the inventory is here. So it's a kind of different sequence, right? So they report non-current asset first before the current asset. So it's based on the IFRS standards. But the point I want to ask you, you can see here they present 2-year comparison in dollar amount and 2-year comparison in percentage amount. So this is common size. So this is one company compared 2 years of their balance sheet, the asset part. So you can see here is 100%. And the rest of them is less than 100%, which is the account, each one of the account divided by total asset. Okay, so total assets are 100%. So you can see the current asset represents 33.9% of the total asset, and fixed asset account for 66.1%. So this is common size balance sheet presentation. Okay, so you put the total asset at the 100, so you can compare 2 year over the year change. Okay, so did you see any major change from this example? You can see the current asset decrease, right? Current asset originally 36.2%, decreased to 33.9. Oh, I'm sorry. This is 2010. This is 2011. Good. So increase. So if it decreases the bad, increase is good. So that means the company has a more liquidity for the short term. Am I right? Okay. And you can look into the other account. Okay. So this is your example for this company using the IFRS. How would they present this asset part? So this is another European country, Korea. They sell a lot of shampoo, facial product, and so on. And this 3-year comparison, and you can see they have a footnote section to indicate, to try to explain for each one of the account. So you can, if you have the 10K report, you can refer to the note to see how do they calculate each one of the major accounts. So again, non-current first, non-current before the current, because this is European country company. So 3-year comparison. So it's very difficult to see because the numbers are big. So that's why later we got to talk about the common size. It's easier to compare the change using the percentage. Okay. So in the learning agility 2 is trying to highlight the current and the non-current session. So this is under the IFRS. So they're not even separate into the current and non-current because there's a rule here under the IFRS. So current and non-current classification are not required if a liquidity-based presentation provides reliable and more relevant information. So this is under IFRS, so you don't need to present really separate non-current and current. So you can see this one will group all together. To me, it's kind of messy. I don't get used to look into this one, but just let you know, most of the time you see it's under the gap, so it will be different. Okay, so one accounting equation here coming from the current. Okay, so there's a current asset and the current liability. So if you're using the current asset minus current liability, you'll get a net working capital. So this is very important. So if you are the manager, one of your important decisions you need to make is watch company financial everyday operation. So you want to make sure you have a sufficient current asset to cover your current liability. So net working capital, which is the assets of the current asset over the current liability, you want this working capital as high as possible. Okay, give you some cushion over there, but not too high. Actually, it's not too high as well because that means you might have too much cash. You just hang out in your account. You did not really produce some return. But this number, we want to see a positive in this number. And also you want to make sure when you look into the company financial statement, you do the financial health, you want to see the change of the working capital. Is it year over the year, is gradually increase or gradually going down? What is the problem? What is the driver for this one? Okay, so this is the definition we showed you earlier. We mentioned about cash equivalent is something very short term. That can be CB, which is expiring a month or 3 months, or the treasury security or money market fund. They are really, really short period of time. So we call them cash equivalent. So you can see there's some disclosure from the company. And we stop here, okay? So I know